We're going to talk about stock investing and have a long term point of view. We're looking for stocks that are discounted. Discounted if you compare the current stock price compared to its intrinsic value, principally on cash flows. The cash flows that that company is going to generate in the future, let's discount them to a net present value based on a forecast we have for those stocks. We also look at earnings per share. We look at price to sales, make sure we're not paying too much price to sales. And we look at balance sheets, make sure those balance sheets look good, and try to find some good stocks to hold for a long time and make a lot of money over time. The stock market has had a good week so far. We're 2 days of positive gains, 1 day of retreating gains. But overall, it's been green for 5 days. Friday was a real good day. We had really nice gains on Friday. It was good to see that Monday was also a positive day, and we kept the rally going. Over those 2 days, it was a nice on the Nasdaq, it was up 3.5%. We did have a day pullbacks on Tuesday, and then we were back at it on Wednesday. So, Wednesday was a good positive day, and Wednesday came I think a bit of news from the Federal Reserve, and I read through an article on the Federal Reserve, kind of like the notes and hearing what other YouTubers as well as channels are talking about. Inflation is ticking up. So that's a problem, but it's not a huge problem at this time. And the growth rate for GDP in the US is slowing down. So those are both negatives. Now, are they alarming? No. Are they in line with what I expected? Yeah, I expected both. You can't have tariffs go into place without having the market, or I should say, prices for certain goods and commodities go up. It's just natural. It's they're putting a tariff on those products, and that tariff's going to add to the price. The growth rate of the economy, is it slowing down? Absolutely. I've seen a slowdown in the economy, and it's not. It's a couple of things that I think are slowing down the economy. One of them is that there's a little bit of unknowns around these tariffs. How long are they going to be? How expensive are products going to be in markets? So I think that's going to continue to linger. And the second is, we've had a very good 2-year run. Some of that run over the last 2 years was really propped up by stimulus money that came in from the federal government related to COVID. Well, yeah, it helped, companies grow when the consumer had a lot of cash in their pocket that they didn't really work for. They just kind of got these checks, and they were like, "Sweet, I got this money. I'm gonna go spend it. I didn't really work for it, so I'm gonna spend it on stuff that is very discretionary." So yeah, that helped the economy in 21, 22, 23 to some extent because savings rate were higher. But now the consumer is getting a little bit concerned, and they're beginning to watch what they spend their money on. That's the thing. Everybody should do that every year, but this year, especially, consumers are beginning to bring pull down their spend and not overspend, kind of play it safe. No sense in wasting one's money all that quickly. On the Nasdaq was up for the last 5 days. Year to date, it's still a down market. We're still in correction territory from the high, which was on February 19th, to where we're at now. We're still down 11.5% on the Nasdaq. The S&P is doing better, but we're still in that correction. Now, this is all good stuff, right? This is like medicine for the stock market. We don't want stocks to get so high that, holy smokes, you're paying, uh, 50 times sales for a stock. You're looking at PEs at 100. I mean, that's just insanity. That's just crazy. Instead, we're seeing, especially like the big cap stocks, are beginning to look pretty darn good. If you look at Meta, it looks pretty good. Google looks great. So some of these big stocks are looking better. And small caps are looking terrific. Stocks in healthcare look terrific. And I'll go over a few that I've selected that look pretty interesting to take a look at. So the Nasdaq, the stock market is in correction territory. I think we took some medicine, and that medicine I think is going to be good for the long haul. And we'll see where today we trade. I think the futures were pointing down, and we'll see where the market opens. We will be live streaming probably for the next hour and a half, 2 hours. We'll see the market open. We'll check back on it and see where it is going. Around the world, Asia, I think traded down. Yeah, the Shanghai, China went down. Hong Kong went down. Japan went down. Europe, um, this market's currently open. In Germany, the DAX is down 1.5%. In France, excuse me, this is the French exchange, this CAC, it's down. And then in UK, stocks are just slightly down. So I don't think there's much to worry about there. Crypto is, in mid 80,000s, 85,000. We we were pretty high on Bitcoin. I think the pullback is consistent with, you know, are we in a euphoric, uh, state of mind? And we were after the election. We're like, man, cryptocurrency is going to flourish. And I can understand that. We saw the Bitcoin go up really fast, like 100%, from September 7th to December 17th, went up like 97. Man, what a run. And since then, it's really settled down. The good news is that it's settled down in the mid-80s. That's that's good. That's really good. Overall, it's still a winner. Over the 1 year, the Bitcoin is up 25%. Over the 5 year, it's up 1,276%. So being a long-term hodler of Bitcoin hasn't been a bad idea. And the space is hard to get your head around, but it's a space that, you know, intellectually and kind of high level, I believe, cryptocurrencies have a place in our economy, in our world, in our future. So that's why I buy Bitcoin and just hold it. I don't do anything with it. Buy Ethereum, do the same thing. I stake it, make a little bit of income on it. And I don't put a whole lot of money there. I just put a little bit. You look at how much I've invested in there, it's like maybe 3% of my overall investing. But now it's worth a lot more because it's gone up so fast. So I'm just gonna let it sit and we'll see where it goes. I'm hoping that Bitcoin continues to rise. And I do believe that, Bitcoin is gonna double in value. I'm gonna say it's gonna hit 200,000 in the next couple of years. It's just headed there. I think it's a scarce investment. Once we get some upward rise overall in the market, Bitcoin tends to really perform. So Bitcoin is holding its own. Good morning, everybody. So it looks like we are 11 strong. Mike, good to see you. How are you, sir? Looks like you want to look at HQY, and then the other one was MRVL. I think that's Marvell Semiconductor Company. Glad to cover that. I think Marvell announced recently, and I took a peek at that stock. I think they got crushed a little bit, if I recall right. Sergio, good to see you. So same here. So is the sound bad? The sound is reverberating. Not sure if my sound is here too. That's weird. You know, so why is the sound bad? Let me put on my headset here. Sorry about the sound, guys. I'm back in my studio. I was traveling for a week and a half. It's my maiden stream here after getting back. Let me know if it's better. I don't know if it is better or not. I just made an adjustment and hopefully that has gotten better. Please let me know in the chat. All right, cool, cool. All right. So good. Thanks for the feedback, guys. Let's continue on. um, so Mike, I noted those stocks. Sergio, thanks for the feedback. And then N Kiter, good to see you this morning. DXPE. DXPE. Cool. We got some symbols coming up that I haven't heard of. Cool. All right, good. Joa and Kyle, thanks for joining. Good to see you. Cool picture, by the way. And Joa Rocha, PDD. Yeah, I had PDD kind of listed. They announced, and the stock's trading down. So we can take a look. We can take a look at that one. PDD has Temu, which is an interesting app, right? It's both. I think it attracts a lot of criticism because they sell a lot of inexpensive products, but the prices on those products, it's really hard to believe. But people buy their products, and some of the deals on there seem like really, really good deals. All right, so let me continue on. I have some opening comments just to go over the agenda real quick. I've got some opening comments that I wanted to go through just to kind of set the table. And then we're going to go over paid member request, just to show my gratitude for members that are paid members for the community. Then we've got some regular viewer request. We've got 3 stocks noted. So thanks so much for showing up early and putting those stocks on the board. And then we'll go through it. We'll look at each stock. I intend on looking at them closely and kind of, if possible, looking at the intrinsic value of each stock, or trying to see if it's going to have good intrinsic value, and seeing if that stock is priced either at a discount, or if it's priced correctly, or if it's priced at a premium. And we'll go through that. So this is a long-term investor channel. If we're not looking to make money today, tomorrow, I think traders, they've got that game. Guys like Trader Prad and others, they tried, or there's some really good option traders that make money in the short term. I wish them the very best. That's not my game. My game is, I want to make a lot of money on stocks over time. And that's the game that I want to play. I want to buy great companies at a discount, find those great companies, hold them, buy more shares when the buying is good, and just hold a really solid portfolio of great companies. That way I can go on trips. I can take time off. No big deal. My portfolio keeps working. I like using the notion of my money works while I sleep. When I'm doing something else, my money keeps working. And being a long-term investor gives you that advantage, or that lifestyle advantage, which is you don't have to pay attention every day. You can take a couple of days off, maybe a week off, maybe a couple of weeks off if needed. All right, so continuing on, and good to see you, Tomas. And then Kyle, you want to look at URI. So we can note that. Noted. All right, perfect. So we looked at overall what the indexes are trading. We talked about the Fed. The heat map for yesterday, the big stocks had a good day, but what's positive is the big stocks have been selling off. If we look at this year to date, Apple's down 14%. I think that haircut was due, and I could see Apple stock selling off even further because I just don't see any excitement in that stock. It's like, what are they going to do to grow their business? It's an iPhone business. Okay, perfect. But the iPhone is losing users to other devices. and the other device makers are excellent. I'm here in the United States, so I think there's probably a very high adoption rate of the iPhone here. But around the world, people watch what they spend their money on, and if they could buy a phone at 20% the cost of an iPhone, they're gonna do it. So they're gonna buy from Chinese manufacturers that create really good devices. So I think there's a lot of pressure on Apple. I think their price decrease that they announced recently, to me, strategically shows that that's beginning to get to them. They're losing the volume, the unit sale battle with other carriers or other phone manufacturers. So we'll see how things play out. But I think the pullback in Apple has been overdue. Microsoft has had a pullback in its stock again. Nvidia, Nvidia's gotten so darn interesting, right? It was such a freaking rock star stock for 2 years, 2022, end of 2022, going into 2023. This stock started to work. In 23 and 24, this thing was a rocket ship. But in the middle of 2024, it stopped. It just plateaued. Hasn't done anything. Will it do anything? I don't know. I think there's a lot of apprehension around Nvidia. I don't think the stories are working like they did before. Nvidia had this huge conference where the CEO spoke. He tried to evangelize and talk, big about what's going to happen with Nvidia. And it did work to make the stock rise a bit, but it wasn't like, 2023, early 2024, where the CEO would talk about, these incredible future, visualizations, and the stock would jump like 10-20%. This is a big cap stock. So it got really expensive. That doesn't work anymore. So we'll see where that goes. Amazon has really been priced, I think, fairly. And for a company as strong and amazing as Amazon to be priced fairly, to me, that's a buy. I own a lot of Amazon shares, and if it gets any lower, I'm buying. Google, I bought a few shares over the last couple weeks. It's really come down in price. I think it's discounted, good stock. Meta's discounted, but I own a lot of Meta. And year to date, look at that. We're in the red for Meta. Keep in mind, the Meta stock was up 25% in year to date for 2025. And it has given up all of that. I mean, it was in January, my portfolio did so great because I have so much darn Meta. And Meta was the big player. It was the MVP of January. But now it's given all that up. So right now I'm in the black, in the green, I guess, with my portfolio just slightly. I'm beating the S&P, but I'm slightly profitable. Year to date 2025. Meta has been kind of one of the headwinds. Berkshire has been kind of just dodging bullets. Warren Buffett, the Oracle from Omaha, getting it done. Broadcom is down 15, and I think it's going to continue to go down. Broadcom is worth 500 billion. It's not worth 919 billion. You can look at videos I do on Broadcom on my channel. TSM, ditto. Tesla's really gotten shellacked this year. Man, now that's a correction that needed to happen. I don't know where Tesla's valued. I think they're overpriced if you look at their free cash flows and so forth. But the market pays a premium because they really like the stories. Although a lot of the stories are kind of pie in the sky, a little bit too much fantasy land kind of talk. But all that other investors invest in Tesla, and I'll just put it out there that I wouldn't touch the stock. Eli Lilly, we get down to the 11th spot, and we see the first healthcare stock. These guys are doing well. I think healthcare is working this year. We look at the sectors. Materials keep staying on top, which is why I wanted to look at some material stocks. I've been looking at material stocks because I can't ignore the data here. The data is telling me Material stocks are working. Why are they working? Well, you have tariffs are beginning to threaten, hey, things are going to be more expensive. Commodities are going to be more expensive. They're protecting domestic producers in the US, and other governments may do the same. So trying to get into the right materials companies, it's probably going to be a good idea. So I want to do a little more work there, a little more homework. I started investing in Ternium, but I'd like to find a second player that I could start investing in. So we'll get into that. I've got a couple symbols that I want to look at. Energy is up. That's good to see. Healthcare is up in third place. Lagging technology. This is where most of this correction rotation is happening, is in technology, because it is the biggest, the most valuable companies right now are in technology. It's a $20 trillion combined market cap sector. It's the biggest one, massive compared to others. Like materials is 1/10 its size. Healthcare is roughly 40% its size. Communication services. Now, this one's a little deceiving because like 3, 4 companies make up most of its value. Google, Meta, Netflix, AT&T, T-Mobile. Those are the big players in that space. Consumer discretionary is there. And this one's kind of a very broad collage that also includes Amazon, Alibaba, and stocks like that. So this is really healthy in my mind. I'm feeling like this year is a little bit balanced. Like, hey, we're taking our medicine here. We're seeing some stock prices sell off. So as a long-term investor, I'm like, all right, good. We're not kind of building up a stock market where we're going to have these stock prices that are going to crash hard. Instead, we took some medicine. Can they go up from here? Potentially. Can they go down some more? Potentially as well. Like we can go down another 10%. That wouldn't be super surprising. If we do go down 10%, man, I'm glad I've got a nice cash pile because I'm going to be buying stocks far faster if we go down 10%, because that means that stocks will be discounted even better, and I could buy into a stock market that is discounted. If it goes up from here, we'll see what happens. I think we'll continue to see that some sectors are better than others, and I want to kind of see where the market's going, what stocks are really going to work going forward, and try to buy ahead of the market so I could see some long-term gains. All right. So earnings did come out, and Pinduoduo announced this morning before the market opened. So we'll take a look at that in a little bit. And I wanted to look at General Mills, which announced yesterday, and GDS and Accenture. So we'll take a look at those in a little bit. I wanted to start with a couple stocks that I had in mind. And let me catch up on comments real quick. Shadow Guy. So hold on a second. So, N. Kiter, you're in Vietnam. No iPhone, zero. That's the point is, when we look at smartphones, right? Like an iPhone, a smartphone, you can look at a browser, you have apps and so forth. In the US, we have this, US centric, iPhone centric kind of, perspective. But there are few people left in the US that don't have a smartphone. I think there's some. Like my mom has one. She doesn't really use it in its full extent. She, and I don't think she'll ever use it to the full extent. But you look at some countries like Vietnam, other Asian countries, there's true organic, like net new users of iPhones. And you look at other regions of the world, net new, they never owned a smartphone. They're buying the first one for the first time. That's pure organic growth. That's really good growth. And I think the Chinese and the Koreans, which is Samsung, are going to really do well in those markets because they provide a very good phone that is going to be attractive to those countries where they have less discretionary income. They don't want to spend $600 on an iPhone. They want to spend $100 for a brand new phone. And can somebody deliver that phone? I think they can, but it's going to come from Huawei. It's going to come from another Chinese manufacturer, or Samsung. So we'll see how things play out. Shadow Guy. Nice. Glad you're beating the S&P, and good to see you, Shadow Guy. Brandon, you want to look at APD. We can look at that. That was APD. Hawker 1000. Booyah. What am I doing with Baba? Well, I love Baba. We can take a look at it, and I'll tell you more about it. All right, cool. Let's keep rolling. So let me get things started with I want to look at Oscar Health, and Oscar Health has kind of had a rough go at it. And this company, there's a couple of stories that are threatening to the company. First is the Affordable Care Act, right? In the US, if they completely do away with it, is it going to really hurt Oscar Health? It could. Absolutely. That's real. Like that story, it's not a rumor. It's if the Affordable Care Act gets taken away. And I think there's, like in the US, if you don't have insurance and then you do your income taxes, there's a penalty that comes along with it. So it's either you get healthcare insurance and you pay for it, or you do your taxes and you end up kind of paying for it without getting any benefit. So it really encourages people, just get healthcare. That way you're not paying more taxes without getting any benefit. That's kind of like common sense. So I think that story's really had this stock trading sideways. I'm really liking their growth, and I like their business plan, which is, hey, we're going to sell to the small business, to the individual. Healthcare insurance, is a necessity. I mean, what's great about like the whole health industry is that we have pharmaceutical companies that created these terrific drugs that help people survive illnesses, live healthier, longer, better lives. I mean, we got like Warren Buffett, who's 94. He's still investing. Isn't that amazing? Charlie Munger was 99. The longevity of people is just phenomenal. I believe a big part of it is healthcare, because when people get to certain situations that maybe 50 years ago, hey, they didn't have a cure for a particular illness, boom, that person didn't make it. But now you have people really surviving, illnesses that used to really take people out, and they live healthier, better lives. But that costs money, costs a lot of money. And people, I think there's plenty of situations where if you have a health event that requires you to be hospitalized, have a surgery, it gets really expensive. So having healthcare insurance is a necessity. And, if you're smart enough to be a long-term investor, you're probably smart enough to be, have healthcare. Now, for the individual or small business, that's a huge marketplace. I like their business plan. I think they're going to keep growing. I'm curious to see if you do get rid of the Affordable Care Act, will Oscar Health still have the demand? I don't know. I really don't know. But that's really going to make or break this stock. If they keep growing at these rates and continue to drive the cash flow they have, this company is going to be worth a lot of money. The biggest company in this space is United Healthcare, and they carry a huge market cap. And that's after many years of the stock not really working, right? So if you look at their stock price in 21, it was $500 a share. It is $500 a share today. But overall, the market cap's $460 billion. So these businesses become super valuable because they have a business that gets premiums. It's profitable premiums. They get to hold that cash, invest that cash, just a lot of advantages that come with this business. So When I look at Oscar, it's a tiny cap, $3 billion. Can they grow and be a $20 billion market cap company? Absolutely. If they grow at the rates that they're growing, 50%, right? That's You're going to get there really fast. You know, you're paying, so it's a $3 billion market cap, and you're paying one third of its sales. Price to sales is 0.33. Have some price to sales on some stocks. It's like 10, 20, 30, and above 10 is really expensive. These guys, you're seeing a high growth business with a really low price to earnings ratio. PE looks good. So this one here I've bought into, but it's had kind of a rough go. It's had a rough go this year. Hasn't been a pretty sight. I still think the stock is really nicely priced, discounted, all the right things, all the right variables for a long-term investor. When we look at their free cash flows, are just in free cash flow for a health insurance company. They don't have to build hospitals. They don't have to manufacture, surgical equipment or anything. They're just involved, and they're basically the conduit between people and the health providers, and they're the in between. So they make a lot of terrific cash, and cash is how I principally value companies. And when I look at a cash forecast for them, I do put a high discount percentage on the net present value calculation of the free cash flow forecast I have for them. I still get a very high intrinsic value of 5.6 billion. And that's well above their current stock price. So I really like the risk to reward ratio. I've heard the CEO of Oscar Health talk, and the guy really knows his stuff. He was the leader of Aetna for a long time, and he is passionate about Oscar Health coming to market and trying to serve what has traditionally, it was underserved, the individual or the small business. They were kind of left way behind. If you work for a big corporation, yeah, your healthcare needs are well taken care of. You're part of a big buying group and so forth. So this guy's doing really good stuff, and I'm really bullish on Oscar Health. But we'll see if the market is going to begin to do something with the stock. Today it's down, so it just continues this, like, it's just not working. But I'm going to hang in there. I'm probably going to buy more shares if it trades down today. So I wanted to cover Oscar Health just to kind of get our minds flowing. Now let's cover a couple of material stocks, and I'm going to get into the member requests and then some regular viewer requests as well. So the first one out of the gate is BHP. Now I've looked at BHP recently, and I think as mentioned, the material space is really working, but this stock here over the 1 year, not so much. Over year to date, it's doing really not well. It's doing okay considering that, hey, the indexes are down year to date. Okay, got it. What I like about BHP is they are a miner of materials and steel, iron ore, copper being the most attractive thing they mine, as well as other materials that they mine for. They're down in Australia. The company is priced at, let's call it 2.5 times sales on their market cap. So that's not too bad. Forward P is only 11, and they have a nice dividend of 5%. When we look at what analysts have to say about the stock, they think it's discounted by 8%, and it's a good buy. This stock really worked coming out of when we had the inflation. This stock really worked. I mean, it really flew up. It pretty much doubled in value. And then it hasn't really done much. And you got to pick your spots with this stock. You got to buy it low and then hold it. I am tracking this stock. The revenue has been consistent last couple of years, or I should say not slow growing. And actually they had pretty good pullback here in the last semi-annual report. These guys are in Australia, so they report twice a year instead of every quarter. Um, Cash flow is really good for BHP. I've noted this company for a couple of years. And when I look at the value of BHP, they present a really a nice discount on free cash flow. And I discount this stock at a higher rate, 11%. Like if it was a US company, low risk, very well-known company, I discount it 8%. BHP is a good company, but they're down in Australia. So it's outside my home country. I'm going to go with a higher rate of return. I'm using the average that they've had for cash flow over the last 7.5 years. And I think this stock is discounted when I look at cash flow. This is kind of like this is the one stock that I've been tracking, thinking of adding to my portfolio and adding to my position in Ternium. This Ternium is another stock. They do principally like steel products and steel mining, and they're predominantly in Latin America. And this stock, I've started to buy into it. I think it's discounted. So this is going to be my 1-2 combo within materials that I think I'm going to roll with. I did look at Vale and Freeport McMoran. Freeport McMoran is a good material stock, and it's been priced up. So I think it's priced closer to its fair value, and it's a good company. It's domestic in the US. It does produce copper, it does produce the right, types of materials. Vale is down in Brazil, and the company, their free cash flows that I saw in 2024, once I looked at their financial statements, were just really low. And I think they have had to pay a lot of money on a settlement that they had to settle because they had a dam accident. A lot of people were killed, and they gave them a really bad image, and they've had to pay a lot of money to compensate the people that were affected. I think that has something to do with the low cash flow. And for me, I need to stay away from situations that I don't quite understand. There's just a little too much risk involved. But when I look at the free cash flows for Vale, it just didn't produce enough value for the stock to be justified based on free cash flows. So that's going to be my approach. Is I'm going to have a 1-2 punch within materials, Ternium being the first one that I've started to buy into, and I'm going to buy BHP. Both are outside the US. BHP down in Australia. Ternium is officially headquartered in Europe, but their operations are in Latin America for the most part. They also have some operations in the US, but it's more for distribution. So that's going to be my approach to materials. Would love to hear what you're doing in materials. Are you seeing the same opportunity or view it as an opportunity? Love to hear that from you. All right. So we talked about material stocks. There's one more stock I want to talk about. Then we're going to get to the viewer request. ADMA had a superb day. So good that I talked to my wife about it. My poor wife. We're watching TV last night, and I was excited about ADMA Biologics. I said, sweetheart, this stock went up. I think it went up like at one point 10% yesterday. Now it's down 3%. So, but this is within the healthcare space. This space has been left behind for a couple years. And when you look at the fundamentals, if you were to view the fundamentals and pretend this stock was a technology stock, it'd be worth like 5 times more. You'd be like, whoa, that's the next Palantir. That's the next NVIDIA. And let's take a look at this. So this is a biopharmaceutical company, engages in developing, manufacturing, marketing specialty plasma-derived biologics for treatment of immune deficiencies, infectious diseases in the United States. They're not the biggest company, 624 employees, founded in 2004. So market cap, 4.73 billion. Revenue, 426 million. So one would pay, let's call it 11 times revenue. Okay. So That is a little bit in the expensive zone. They better be growing. Forward P is 29. Strong buy 13%. Year to date, it's working up 17%, and it's had a nice recent rise starting late February. And keep in mind, what I like about healthcare is while technology is selling off and kind of, I think, correcting its excessive pricing, that money is going into healthcare. You could see it here, right? Um, so this stock's done nicely year to date. And this is what catches my attention. Again, if you saw this in technology, this thing's going to be worth 100 billion. If this is in healthcare, so maybe healthcare is going to begin to get more investors to say, hey, well, that's terrific growth, 65%. What do the margins look like? Gross margins of 51%. And I would say that you see how their gross margins are expanding. That's because they're getting bigger. Their scale is getting developed. And as they get bigger, they're going to be more profitable, right? They don't have to build like the operations to support this business once or maybe a couple of times. Then they make a lot of profit if they keep growing. So that looks terrific. The expansion in gross margins. So the growth in revenue looked terrific. The expansion in gross margins look terrific. Overall profit margin looks terrific. And free cash flow they're now free cash flow positive. It's like, man, this is exciting. So I'm glad I'm an investor. I'm glad I've got some shares in ADMA. We were like, as a community on our calls, we've been kind of digging into healthcare and seeing where are there some potential really good winning stocks. And this one came out of that type of conversation that we've had. And I'm glad I bought some shares in it. When I look at the value of ADMA, and ADMA is going to be a stock where I have to constantly reevaluate it because every quarter when they announce, they're going to give us, it's almost like a puzzle, right? When you have a puzzle, and let's say you're dealing with like a Google. Well, imagine a 500-piece puzzle. And with Google, you've already put 400 of the puzzle pieces in place. So you kind of see the picture. You kind of see the big picture. ADMA, you just got the box and you open the box and you have the puzzle pieces and you have a couple corners of the puzzle kind of assembled. You're beginning to assemble the picture. So every earnings call helps us put a couple more puzzle pieces into their proper place so we can see the bigger picture. Is this business going to make it? Is this business going to reward me? And, double in value, triple, quadruple, 10 bag, that's remains to be seen. Because what could also happen on an earnings call is bad news. The FDA is questioning our treatments, or a competitor came out and they're threatening our market space because they have a treatment that's even better than ours. So that's what's going on with this company. It's small, so it needs more attention because could be more surprises, upside surprises or downside surprises. So far, so good. I'm estimating the cash flow. Now, I want to repeat something that Pat Dorsey, and if you guys watch my channel, you know that I like listening to Pat Dorsey. I read Pat Dorsey. I study Pat Dorsey. I think Pat Dorsey is brilliant and he's performing. His portfolio is doing great. So he's killing it this year. He's super smart. He has a lot of good things to say. Like Warren Buffett has a lot of good things to say. And Pat Dorsey believes that when you look at the known financial data, right? Okay. We have price to sales, we have PEs, we have those types of things. The market's efficiently priced. What does that mean? It means that investors are taking all those into account and fairly pricing a stock. Okay, perfect. But where the market is inefficiently priced, and that's where the money is made, is in the qualitative decisions you have to make on a company Is this company going to keep growing? Is this company cash flow going to continue to expand? Those are qualitative decisions you have to make on a stock. And that's where the money's made. So when I make a decision on where the stock is going on a cash flow perspective, that's where I take into account their market space, the establishment of their scale, and their ability to continue to grow their gross margins, which is going to continue to grow their free cash flows. And I estimate a free cash flow estimate or forecast here. This is very qualitative, taking quantitative data and then being able to make good qualitative decisions. And I put together a forecast for ADMA. I discounted by 10% because they're smaller. They're not a very well-known player like an Eli Lilly. These guys are a tiny little company making a lot of noise. Okay, higher discount rate. I want a higher rate of return. I'm taking a higher risk. And then we get to an intrinsic value of those cash flows of almost $7 billion. Well, the market's priced at 4.7 billion. So it's a nice discount on a high growth business. Again, if this was a tech stock, this stock would be worth 100 billion bucks. It'd be like investors would be climbing over themselves trying to get shares of ADMA, but it's a healthcare stock. It's a biologic. How long will their, solutions and treatments last? All those things we have to study and make decisions on. So I like ADMA. Had a good day yesterday. It's having a good year. Keep it going. Come on. You guys can double in value in 2025. Make it happen. All right. So let's get to some of these member requests and let me catch up on some comments. We are growing in the audience here. Thanks so much for joining. I appreciate you joining on a Thursday. What's the market doing? Is the market going to treat us kindly? No, not, we're not getting abused today, but it's not an up day. The Russell's down, the NASDAQ's down, S&P's down, the Dow's down. Okay. No big deal. Let's see if we can rally yesterday or later. Rotel and cheese. So you want to take a look at light. All right. We'll take a look. And then, okay. So Tomas, what is your opinion on trucking industry? Yeah, I can take a look at, it looks like you want to look at TFI. And I'll give you comments on the trucking industry while I do that. Thanks for asking. Rotel and cheese, ACN. All right, we'll take a look at that. Shadow Guy. So just saw an interview clip with Oscar CEO. He wants to closer to Swiss Health System. Yeah. When you listen to the CEO, again, qualitative, you get qualitative information, which is, does this guy really get it? And my conclusion is he absolutely gets it. He ran a big insurance company. He understands what works and what isn't works. And he understands where there's a market opportunity. Hopefully he's going to nail it. And I think Oscar Health is going to go up in value. Wholesome. Yeah, you've been looking at Wholesome. Let me take a peek at that again. I think I got to revisit that. All right, good. So they're going to spin off Amriz. Okay, we'll take a look at that. All right, so thanks for being patient and letting me kind of open up and then go through some stocks that I wanted to cover. I think Mike wanted to look at HQY. Let's take a look at HQY. Health Equity. Health Equity provides technology-enabled services platforms for consumers and employers in the United States. The company offers cloud-based platforms for individuals to make health savings spending decisions, pay healthcare bills, receive personalized benefit information, earn wellness incentives, grow their savings, and make investment choices. So these guys are kind of a health savings accounts company, and it's a little bit kind of like financial services meets healthcare insurance space. So interesting. Let me take a peek at their website. So these guys, so this is your health savings account. And, I got to get more familiar with this because as I venture into the future, I think this is something I want to start doing. So I want to get familiar with it. Okay, cool. There's a lot of advantages to looking at a health savings account. And, as I definitely put a lot of time and energy into managing my stock investments, my real estate investments, and bonds and crypto. But I think I could do more in this area for me. And I think companies like this, I'm glad there's companies like this. So I'm gonna look at this stock, and I'm gonna come back and start getting more familiar as potentially becoming a customer. So I'm glad they exist, making it a little more like, hey, you can make money on stocks over time. Hey, you can take a health savings account and really manage it well. And then over the next 20 years, as my wife and I and need health care, we're taken care of. And we did it in a smart way, which is, we managed our account and got what we needed at a lower overall cost. So these guys are a small cap, 7.23 billion. I like their business, kind of high level. Hey, this is different. I'm glad they're doing it. I wish this would be more, we would get more education on this, frankly. They're selling at 6 times revenue, not bad at all, depending on their growth. Forward P is 23. Analysts say it's really discounted. Over the 1 year, you haven't done great, but I think stocks are beginning to not look so great over the 1 year. Year to date, this thing has been selling off. It was $114 a share. We're down at 84. That's a pretty good haircut. Yeah, it's about a 26% haircut over the last month. What's going on? Why is the market selling this thing off? Growth looks good. They're pretty good size, $1.2 billion in revenue, and growth at 20%. Now, I showed you Oscar was growing like really fast, right? It's like 65%. So 20% is good. It's just not exciting. On a $1.2 billion business, it'd be nice to, and they are accelerating their growth. What's the quarterly look like? That's right there at 18.8. So consistent with that 20% growth rate. Now, when we look at so they're growing at 20%. Free cash flow looks terrific. Look at this growth in free cash flow. Nicely done. Nice upward chart. I would drink to that. Free cash flow growth is a very solid metric to see that the business truly has value. If you can bring your company up to a certain size and scale and then really start cranking out cash, that's why those big value caps are worth that much, is they crank out cash. And these guys are really showing that ability to grow their cash flow. Gross margins are expanding. As they get bigger, they get more profitable. Love seeing that. So the growth is good. At this rate here, their margins are expanding. This business, I'm going to multiply 337 times 25. I get to 6.6. So I'm going to get to about $8.5 billion in value. and they're at 7.3 billion. So I think these guys are trading at a discount, a decent discount, like 20%. It looks like the stock has been going up for the last 5 years. Over the 1 year, the market's beginning to get, remember how I said that, when a business is young, it's like getting a puzzle, 500 pieces. And when they're young, you're just opening the box and you're putting the pieces in place. And I think shareholders, we're getting more puzzle pieces and we're trying to put the picture together. I think the stock hasn't been rocking as well as it should is because the growth hasn't been there. See, like 85% growth, that's exciting. 40% growth, that's exciting. But they kind of hit a wall. Now, what's going to be a catalyst? Now we're talking qualitatively. What could make this business work, right? So just thinking out loud, the current administration is going to break a lot of departments in DC, right? You have some departments that are just completely being eliminated, while others are, pretty much it's just an elimination. I don't think we're creating many new departments. Healthcare is a huge expense. Now, if they create a situation where companies like Health Equity could become really important, because if they make it so that people should really have one of these accounts to manage their spend on healthcare, it could really be a catalyst. That's potentially a tailwind. Are there any risks? Are there any headwinds that could hit this company? I think that's a good place to kind of get your head around. I think it's an interesting company. I'm going to look closely at it for a couple reasons. One is from a stock investing perspective, but secondly, from hey, I might want to be a customer perspective and start putting money into this, or planning on doing so. So it's an interesting stock. I think it is modestly discounted, I think, and that's assuming that their balance sheet was good. I'm going to assume that because I'm going to say that. Let's see here. So they do have some debt. So take that 8.5, reduce it by 800 grand. So we're down to like 7.77, somewhere around there. So they have a very small discount. I could get a better risk to reward situation in another stock within the same general sector. So for me, it's going to be a pass, but I'm going to look into it and probably keep an eye on them, because this could turn into a really interesting business. And the other question I would have is, are the bigger health insurer payers also providing these types of solutions? Like, does United Healthcare provide it? Elevance? Is Oscar potentially providing this? Because that'll be competition on these guys. And people will not want to have multiple health providers, healthcare paying providers. If their principal health insurance payer provides a health savings account, they'd probably go there and get it as a combination. All right. So thanks for asking about that, Mike. That was an interesting one. Let's take a look at Marvell. So Marvell, if I recall, man, look at this sell-off. Now, semiconductor was so inflated, and it really was a bubble. Semiconductor historically is cyclical. Let's take a look at, so you have growth, contraction, growth, contraction. And the contraction for these guys happened as recently as 2024, right in the height of the AI hype. Like, hey, AI is going to be exciting. And fiscal 2024, this ended at very early in the 2024 timeframe. So this is more representing 2023. But you look at this growth rate. This is how hyped up semiconductor was, is, man, AI is going to need so many more semiconductors. Okay, that's a logical statement, that if you have a lot of demand on AI applications and solutions, you're going to need the infrastructure to back it up. So I totally see that type of demand growth in Nvidia. But look at Marvell. It's like for the trailing 12 months, 5% growth. Really? Let's take a look at the 5-year. But your stock really took off during the AI hype. So your stock went from $40 a share, it tripled in value. Meanwhile, your revenue's like hasn't gone anywhere. So, you're kind of, as an investor, it doesn't match. Like the hype doesn't match the results. Now they did have very good growth in 22. Kind of unusual to see. 2022 was a tough year. And then 2023, maybe they had an acquisition or something happened there. But this is what is kind of where the market's kind of lost its way. Is semiconductor just became so overpriced. Here's a very good example. These guys tripled in market cap, and meanwhile their revenue was pretty flat because you had a negative year, you had a positive year, single digit, and net it was like they're the same company size. See, 5.7, 5.5, 5.9. So over the last 3 reporting periods here, you have a company that's actually contracted a little bit, but their stock price tripled. What? Is it just because everybody who's a semiconductor stock went up in value? Yep, that's what it is. We look at free cash flow of 1.4 billion. This is a single digit, mid-digit grower. I can maybe get to 15 billion in market cap, but they're at $60 billion in market cap. This one's got a lot of pain and suffering ahead of it. It already has a fair amount of pain and suffering for investors. If you're an Marvell stockholder, you're down 36%. This is going to continue on. Let me show you some of these graphs from the dot-com bubble. Let's go back into the Wayback Machine. Let's go into Intel. This is the original rock star in semiconductor. Dot-com bubble. Man, we're going to need so many semiconductors. They were right. The stock just jumped up. It's never gotten back to that share price. The stock sold off. The company kept growing. Its revenues becoming bigger. It doesn't matter. The stock got so ahead. The euphoria, the hype took Intel into the stratosphere. And once it broke investors were like, I'm never going to touch Intel again. I lost so much money on that. So I'm never going to touch it again. They never touched it until they started touching it around 2015. It started to work. And now Intel's a dumpster fire. But this is my point, is when you have a stock get euphoric and you see Marvell, whoa, see that chart? It's like bananas, right? Like, whoa, it went up 300%, 200% if I go from here to there. And I think the correcting is going to happen. It's going to settle back down to, I don't know, $25 a share, $40 a share, and kind of bump along the bottom, because investors, once bitten, twice shy, they're not going to want to touch Marvell. You lost so much money, you're not going to touch it. I don't care if it looks discounted. I'm not going to touch it. Is going to be the mindset. So that's where Marvell's at. And I think semiconductors are super risky right now. Broadcom, super risky. Nvidia, I have no idea what's going to happen there. And there already is a big pullback in the data center. You have all the big data center companies saying they're pulling back because the market has told them you're spending too much on CapEx. So they're pulling back. So that is Marvell. Tough times ahead. And you see how analysts, they were part of the hype train. In a way, I think analysts are in on the whole kind of market conspiracy. they want to believe the storylines, which is, hey, AI is going to be super important. I'm not saying it's not. It's just not going to be built out in 2025. It's maybe 2035. We're going to wake up to a world where it's like, wow, we have all these AI experiences and robots and self-driving cars and who knows, even self-driving car or flying cars and all kinds of neat things. Yeah, but that's 10 years from now. I'm an investor. I want to make money this year, next year, the year after. So I want to invest in stocks that are really going to be really good growers and appreciating in value, not crash and burn situations like Marvell. And investors have bought in. If you look at the growth, you have the year that just closed is here. They're supposed to grow here substantially. That looks interesting. But see how the cyclical industry growth, slow down. That's semiconductor. And for the last 2 years, investors have been pricing semiconductor like it's the next Google. It's the next, Amazon, where you have consistent growth year after year, compounding of growth, compounding of profits, compounding of free cash flows. No, you have cyclical cycles. You have growth, decline, growth, decline. You also have within semiconductor, compute and the ability to do certain tasks, workloads on those semiconductors. You have competitors coming into the market with better technologies. For example, the GPU, NVIDIA came out a long time ago with GPUs, and they were used for video gaming. Then they were used for mining Bitcoin. And then ChatGPT, OpenAI used them to build a large language model. And in 2022, it was realized GPUs are really invaluable. Well, in the last 2 years, 3 years, DeepSeek came out and said, well, we can do it in a cheaper way. That happens all the time in this space. So what Marvell believes is their competitive advantage is an advantage for a year, 2 years, until their competition says, hey, we built a better mousetrap. We can do it in a better way. So that's always been, has always existed in their space. So a lot of pain and suffering in semiconductor to come. I am invested only in Qualcomm in a small amount, and Applied Materials, small amount, tiny amount. I'm concerned that we're gonna go back to these days. And Intel was the big giant gorilla in semiconductor, and they sold off. This could be NVIDIA, by the way. This could be Broadcom. It sells off. Investors just go away. Since we're talking about semiconductor, let's take a peek at NVIDIA. Got to talk about NVIDIA, the big monster, and talk about the fact that, hey, if we look at May 29th, 2025 is roughly 2 months away. 3.5%. So once you have that compare, psychologically, I think the NVIDIA stockholder is going to be really concerned. Like, this has been dead money for a year. I thought this business is supposed to be super exciting. Yeah, except that you have a stock that went parabolic. Once you go parabolic, baby, it's really hard to sustain this growth. It's impossible. If you continue to grow, you would be way up here. 80% of the whole index of like NASDAQ would be NVIDIA stock. That's just not possible. And you're dealing with semiconductors. You already saw DeepSeek change the game, and you're seeing other technology providers change the game. Our friends in NVIDIA had just had a big conference, and the CEO went all in on their new technologies, and they came out with the latest, I guess, technology. I believe it's called Rubin, and that's going to supersede. They're going to cannibalize their previous technologies, one they just released. That's what they have to do. And that's the nature of their business. They don't want to be replaced by somebody else, so they will self cannibalize. So that's what's happening with semiconductor. Right now, it's really tough to invest in semiconductor. All right. Thanks, Mike. Nkiter, DXPE. DXPE. So DXP Enterprises, together with its subs, engages in distributing maintenance, repair, operating products, equipment, services in the U.S., Canada, internationally. It operates 3 segments: service centers, supply chain services, innovative pumping solutions. All right. Got it. So if you run a factory, if you have operations, these guys could help you. They also have a pump business, supply chain services, renewables. Okay. All right. So let's take a look at their fundamentals. Over the past year, the stock's up 73%. Very nice. This is an industrial. Wow, that's a really nice rate of return year to date. It was up trading higher. It pulled back with, the rest of the market, but it's still doing well for the year, up almost 8%. It's a very small cap at 1.4. You're buying the company less than 1 times sales. So that's very good. Forward P is 16.85. It's a buy according to analysts with a small discount of almost 7%. Really good steady growth. Very good growth. Okay. And looking at the quarterly, you're actually seeing expanding business, right? They had a contracting quarter in Q1 of 2024. Okay. And overall, their business is expanding. That's very good. Looking at free cash flow, $77 million. It did contract a little if we look at 2024 compared to 2023. Gross margins, low gross margins. Yeah, these guys are selling, parts and so forth into factories. They got to compete on price. There's a lot of cost into the product itself. You have materials, direct labor, all kinds of stuff into that product. Profit margins are a little low. Free cash flow margins low. All right, so not a lot of cash flow to work with. $77 million. And historically, it's not like they're showing a growth trend. Like back in 2020, they were at 103. Now they're at 77. So this one here, let's take a look at their balance sheet. This is kind of like a little bit of a more old school business. They do have net debt of $544 million. When I look at their free cash flow and I round up to 80 million, and I mean, it's a slow grower. It's good to see them expand their growth. I get maybe to $700 million in market cap value based on free cash flows. And then that debt takes away most of that value. So I'm nowhere near their current market cap. I think these guys are working. Their growth is really making a lot of believers out of investors. The problem I have is not enough cash. I couldn't touch this stock. Not enough cash. The analysts are focused on earnings per share, which is a different number. Only one analyst covers it. So not a lot of data out there. Modest growth. So this one here, Nkiter, is just the cash flow doesn't come anywhere near its current market cap. The stock's worked. Look at that. 635% growth. Amazing. But low margins. I'm gonna stick to my process. I'd rather buy 3M in this space of industrials. Let me take a look at 3M real quick. So 3M's had a troubled past. It had a couple of judgments against it. It settled those judgments, and then it's really had a better go at it over the last 12 months. So this was a situation where buying at the right time was a good idea. Forward P is 19.6, and it's an $83 billion market cap company. Revenue is 24 billion. So less than 4 times sales is what you're paying for the business. Now, when we look at the quarterly, they've stabilized their business, very little growth, but they were getting rid of, they spun off some businesses, and they've stabilized their business and now have gotten the confidence of the market. This is a very solid brand. I mean, they've been part of the American economy for a long time. And their free cash flow, if they can get back to historical cash flow, big cash flow, better margins than we just saw out of that other little company. And overall, this has been the company that I'd rather invest in within industrials. And I'm currently buying more shares of 3M. I think it's discounted, and I'll continue to buy 3M. So thanks for asking about DXPE and Kiter. So Shadow Guy, you brought up Wholesome, and I think you said that they're gonna spin off part of their business. So let's see, which one should I look at? Wow, nice. Up 30% for the 1 year. It's up nicely this year. Very nice. So Wholesome, together with its subs, Building Material Solutions Worldwide. So they do ready mix concrete, aggregates, crushed stone, gravel, sand. Okay. So the stock's working for the 1 year. It's really worked for the 5 year. Really solid business. Materials, $63 billion market cap. We're seeing this USD. Okay, good. And you're paying a little over 2 times sales for the business. PE ratio 19.5. They're in a contraction if you look at the annual. And I'm not overly excited about the building, industries. I don't know that there's like going to be huge growth in this space. So that'd be, see how this is cyclical. You have growth, contraction, and maybe investors are thinking, hey, this thing's going to start to grow. So they report twice a year, so every 6 months. And for the CIMA annual reports, we've had contraction in each report. So I'm going to look at free cash flow here because this kind of converts it over to US dollars. And they have good free cash flow of 4.43 billion. I'm going to multiply that by 10 minus debt. So that'll get me to 44 billion in market cap. They have about $9 billion of net debt. So call it $35 billion is where I can get a valuation on free cash. And that's short of the market cap. So these businesses, I'm not quite sure why it lands so darn short on these businesses, but I'm not getting there on a free cash flow. And I can't really give them a big multiple on free cash flow because they're not growing. It's hard to do that. But the market has really liked this stock. So the market's going to do what it does. And those are my comments on Wholesome. Hopefully you're in this stock and you really have benefited from the appreciation. It would be a pass for me, but it's just based on cash. And you said that they would be spinning off Amrise. And nothing out there yet. Okay. So it'll be interesting to see that when it happens. Well, thanks for asking about that. All right. So let's move on. All right. So looks like we have more people on. Thanks so much for joining, everybody. Appreciate it. I'm going to catch up in comments in a few minutes. I have a list of stocks that some viewers have requested, and they've already been waiting for a while. So I'm going to keep rolling. And if you just joined, this is a long-term investor live stream. We look at companies and we want to get an intrinsic value based on cash flows. We'll look at earnings per share. We'll look at what you're paying from a price to sales ratio and see if we can find some discounted businesses. All right. So Magical Self wanted to look at ISRG, Intuitive Surgical. I've looked at this stock. This stock has really run up, and it's, in my opinion, overpriced. The run up has been really impressive, right? 265 over 5 year, but you're seeing this really strong pullback year to date. Now, this was a darling for a couple of reasons. One is I think in large part, they deserve to be really respected because they've been growing their business and so forth. Now, it's $178 billion market cap. Revenue is 8.35. So you're paying 20 times revenue. That's high. That's expensive. So that's the first sign that this could be priced too high. 20 times sales. So let me give you an example. We all know and love Google, right? So Google is 2,350 billion. This is roughly 6 times revenue. So I got Google 6 times, growth rate 14%. This thing's 20 times. Whoa. Growth rate about the same. Okay. Intuitive Surgical, based on price to sales, looks expensive because I'm just showing you same growth rate and Google's way bigger. And you're paying up for this stock. I'm like, whoa, if you had that kind of price to sales, I expect to see a higher growth rate there. All right, so that's 1 point. Forward P 61, expensive. Let's go back to Google. All right, Google, what's your 18? Whoa, that looks like a bargain. Google is on sale. This one's 61. Whoa, expensive. Analysts are like, oh, don't ignore the expensive PE, ignore the high price to sales ratio. It's discounted by 16%. Really? That's on earnings per share. Okay. Well, I don't use earnings per share as a principal decision factor. I look at free cash flow. So let's take a look at that. So free cash flow has not been very dynamic. It hasn't been growing much. High point was 3 years ago at 1.75 million. Excuse me, 1.75 billion. Now it went down and now it's up to 1.3 billion. Based on their growth rate, I'd value this company at like 26, maybe $39 billion in market cap, less debt. And they have roughly $4 billion of cash. So the highest value that I can give this company is like $40 billion, 40 billion compared to $178 billion current market cap. Really expensive stock. I would not touch Intuitive Surgical. I think this thing's going to punish investors over time. It's a cool company. They have cool products. I think there's some Da Vinci system, and I think people are really, or investors, especially retail investors, are captivated with the AI kind of vision of a lot of these things are really going to happen. So this one here is just a really expensive stock. I would not touch it. I would not deal with it. There's a lot of great opportunities in healthcare. This isn't one of them. So thanks for asking about Intuitive Surgical. Good luck to you, sir. Thanks for asking. So you, Clear Secure, these guys, what's going on with these guys? They're doing okay for the year, 4.43. These guys do a combination of things. When you go to the airport, and I did travel over the last 2 weeks, and these guys are right next to TSA PreCheck. I'm TSA PreChecked, and they provide an expedited service to get on an airplane. And they also do some other services, but the principal service is what I just explained. Over the 1 year, it's up 46%, but you can see that it really sold off. And it got interesting. $3.8 billion market cap, revenue is $770 million. So you're paying, what is that, about 5 times sales for the company. Not bad if they're growing. Forward P is 20. When we look at their growth, they are growing nicely. So that price to sales looks really good. It's not that big of a market cap. They keep growing their revenue really nicely. And they have good free cash flow. And the cash flow has been expanding. This one is a stock that, look at that free cash flow growth. Beautiful. Gross margins keep expanding a little bit because of their scale. Looks good. Now, a couple of themes that concern me, right? So first, I think this stock's discounted. I believe I've got this thing already pre-evaluated. Unless I deleted it. No, there it is. Okay, cool. So very high discount. Okay. Just the market hasn't taken this stock higher. I was trying to pick the right time to reinvest in this company. Here's what concerns me about their space is I think the travel space is really going to go into a recession within that particular industry. You're seeing that the airlines are saying, hey, travelers are really not traveling. They're slowing down their travel. They're concerned about this economy. So if you have fewer travelers, you're going to have fewer people saying, hey, I'm going to subscribe to the Clear Secure subscription. If they're like, yeah, I'm not going to travel in 2025, maybe slow it down in 2026. I got to conserve my money. The economy isn't going to be as good. I think Clear Secure is going to see a headwind. So I'd be concerned about that. This is a discounted stock. It really is. You just need to pick the right time to invest and see if the market's really going to recognize it. It places itself, according to Stock Analysis, as a technology company, as a software application company. I don't agree with that. They're a service company, right? They provide this subscription and it's a service. So I guess you could call them a software as a service, a platform provider, but they have to put a lot of people in the field providing, the guidance for people to check in and so forth. So I'm not completely sold on their business. I think they're going to have some macro forces that are going to make it hard for them to grow. So we'll see how things play out, but it's a discounted business. Good luck in your decision. It's always going to be discounted. I'm not sure if I could see these guys being acquired. I mean, look at the 5-year. It's really amazing that they came out priced so high back in 2021, and then they sold off and not gotten back to where they used to be. So this one's not clear cut. It hasn't broken any records in the current year. So good luck with that one. Discounted, but the market, I don't know if it's going to be excited about that stock. Pinduoduo. So these guys are now up 1.6. They were down in the pre-market. Getting it done, 32%. Nicely done. This company is $177 billion market cap, $54 billion in revenue. So you're paying about 3 times revenue for the company. Nice, affordable, low cost acquisition of a company. Forward P of 10, low, discounted. God dang, man. Look at this revenue. Beautiful. This isn't the Chinese currency, so I'm going to go here. This converts it to US dollars on stock analysis. And when we look at balance sheet and the price to sales figure I showed you, those were US dollars, by the way. It wasn't the yuan dollars or yuan currency, excuse me. So debt is low, $44 billion of cash sitting on the balance sheet, ready to acquire other businesses, ready to grow, ready to do all kinds of things. $44 billion. So you really, your market cap is 177 minus 44. That's going to bring us down to 133. Your market cap's really 133 because you have so much cash on that balance sheet. That's amazing. Free cash flow, 16.82 billion. Man, that's a lot of cash flow. So the business, based on their high growth rate, but they are in China, so you got to take a haircut because they're in China. This is worth 300 billion all day long. All day long. Easily worth 300 billion. It's 177. China stocks are working. This thing, if China stocks continue to work, this thing will get north of 300 billion in market cap. And the space is working. What are Chinese stocks doing today? What are they doing? Are they working? Let's take a look. Here we go. So today we've got where's Pinduoduo? Thought I would have seen it here. So here's Baba, JD, Baidu. That's where I'm not seeing it. But today's movers are, and I shouldn't have done that. There we go. So Baba is down, down, down. So the whole space is not moving today up. So the fact that Pinduoduo is up, it goes to show that, hey, their earnings were really positive. They announced before the market opened. So very good news there. So I can't argue with buying of Pinduoduo. Really good company. I own Baba. Happy with Baba. Good with Baba. Good luck to you with Pinduoduo. Good discounted Chinese stock. All right. So Kyle wanted to look at URI. United Rentals. Interesting. Let's take a look. So this has been selling off. This is kind of a sign that the economy is slowing down. United Rentals is going to do well when the economy is expanding. And we're seeing kind of a little bit of a contraction. Look at that. Wow. Amazing. Now, these guys were thriving for the last couple of years. I wonder why. $41 billion. You're paying 3 times revenue for the company. I think they're an industrial, right? Yeah, industrial. Forward P is 14. They've been growing. Most recent quarters continue to grow. That looks really good. Okay. So free cash flow is roughly about $2 billion. and they're growing single digit. They were growing better in 23 and 22, but now it's single digit. They're accelerating a little bit in the most recent quarter. All right. And so $2 billion of free cash flow, and their free cash flow, it doesn't show like an upward trajectory. Like you were at 2.3 in 2020, down to 1.4, 1.7, 2.2, and then 1.9. So it's not showing like a direction of free cash flow is going to continue to expand in a nice trajectory. Gross margins are okay. It's an industrial. They rent stuff, so they have to depreciate that stuff. They have to service that stuff. They had to deliver this equipment and so forth. All right. So these guys, I mean, they're worth like 30 billion. I'm going to multiply 2 times 15, get to 30 minus debt. So 30 minus debt. And they have a lot of debt. They have $14 billion of debt. That's a lot of debt. So really the business is worth 16 billion. And they're priced at 41 billion. So that's a very expensive stock. And investors have really liked this business. Hey, my hat's off to you. I don't get it. Low margins, 40%. You have a lot of debt, not good. I just showed you in this stream, we probably saw 6, maybe 8 businesses that had cash surpluses like Pinduoduo. They had like $44 billion of free cash. That shows that business is really valuable. They get to accumulate a bunch of cash. United Rentals has to go get debt to buy equipment to then rent it to people. It's expensive to put that equipment in the field. You imagine how much that equipment depreciates quickly. It's a rental equipment. So all those things put into kind of a package, it's not a very desirable business. So why investors are paying like a lot for the business, 41 billion, is probably because retail investors can get their heads around this. Hey, United Rentals, I understand what they do. I see their equipment. Maybe I'm in an industry where we rent stuff from United Rentals. Cool. I would just rather buy a business that has far better margins, far better free cash flow, far better metrics. And this one just doesn't do it for me. It's a complete pass. I would not buy this stock. I feel like the market has really priced this stock up. It's beginning to sell it off. We'll see where it ends up, especially if we get into we have a economy that is slowing down. It's not contracting. It's slowing down. But if you have a slow economy, United Rentals is going to struggle. It's going to struggle. What if their equipment is being imported, which I'm sure they're importing some of their equipment? Well, that tariff is going to be a problem because now they have to pay more for the equipment. And it's not like they buy the equipment and they sell it to their customer. They buy the equipment and then rent it to their customer. So their customer may not be willing to have a higher price or get a higher price. They're like, no, I want to rent it for what we said you were going to provide the equipment last year for. So that is a complete pass based on free cash flow. This business is too expensive. Margins are not good. It's a pass for me. What's the goal of my investing strategy? Is to buy businesses that are discounted based on free cash flow, the intrinsic value of free cash flow. This one here, just the cash flow doesn't cut it. They're not growing. It's not like these guys can double in value, double in sales very quickly. It'd be very hard. They'd have to buy a lot of equipment, take on more debt. Debt is not good. And I forgot to check, what's your debt to EBITDA ratio? I want this to be less than 3. These guys are right there at the limit. I want it to be less than 3. They're barely less than 3. So pass on this one. All right. So let me catch up on comments. We are going to need to end the show a little early, and I apologize, but we've been going for an hour and 40 minutes. And it looks like Rotel and Cheese, thanks again for joining. Blocks for Fun, thanks for joining. Shadow Guy. Jack Lake, thanks for joining. I apologize. I can't look at the symbols you've got out there. I just ran out of time. And Mike, thanks for joining. I appreciate it. And we'll see what Nike does. It looks like your handle is A with the tiger picture. Yeah, that's probably the most interesting stock after the market closes. Nike's going to announce. I think Nike's got challenges ahead. The tariffs, if the tariffs stick around for a while, it's going to put a lot of pressure on that business because they import all their shoes. Tomas, thanks for joining. I'm sorry I can't cover that symbol. ABB, thanks for joining. Mike. Did the market turn green? Well, that's good news. Maybe I should keep talking. Yeah, very nice. Very nice. All right. Way to go, stock market. Let's take a look at this here. So we are seeing appreciates. Look at this Meta. Beautiful. That makes my day. Oh man. Thanks for telling me, Mike. I was having a great day to begin with. And man, that Meta being up 3.84. Why is it up so much? Amazing. And other stocks are doing well. Even Adobe's up. Adobe is in my doghouse. Everything looks good on the stock, but the market's like, yeah, we don't like Adobe. We're not going to buy Adobe. So sector-wise, communication services, because Meta's up so much, 1.2% up, discretionary up, technology up, healthcare is up. Materials down, opportunity is knocking on our door. So that looks good. Very good. Thanks for the heads up. And Nicolas Para, thanks for joining. Sorry, I can't cover Pepsi. I've got to get moving on other things I need to accomplish today. If you'd like to, paid members, I always cover paid member stocks first just because they support the channel. I'm sorry I can't cover all the just regular viewer requests. We just ran out of time. Become a paid member and your stock symbols will be prioritized like I did on this stream. And I hope you understand why. You also get other benefits like attend paid member calls on weekends. And I'll invite you to the Discord where we can talk about stocks. So that is it for today's live stream. It's good that the stock market is rising. Good to see that. And let's hope that it keeps going up. It'd be nice to have a nice green week. We've had a pretty good correction in 2025. I think we've taken our medicine. And again, I could see the market selling off another 10%, but I could see it saying, okay, we took our medicine. Let's just go ahead and start growing or appreciating stock prices in the right places. I still think healthcare is a terrific place to find value. Materials keep showing up as, hey, we're going to keep going up because these tariffs might raise commodity prices. And if it does, those companies are going to make a lot of money. And their materials are a necessity for the global economy. So that's where we're at. Everybody, thank you so much for joining. I appreciate it. I hope it looks like Mike, we've got one more comment from you here. Good. Very good. I hope it keeps working. The fundamentals on you look terrific. So hopefully it keeps working for you. But with that, everybody have a terrific day. Good luck with your investments. And I appreciate you tuning in. And I'll try to stream again, maybe late tonight or tomorrow. I certainly want to go over Nike. It's a stock that I have covered in depth and would like to cover it after they announce their earnings. So I'll be covering that. All right, everybody. Have a terrific day. Thanks for tuning in.